Hey, what's up all of you beautiful subscribers? I'm Jack Chapple, and today we're talking about one of the investment principles of the super rich, and that is the power of depreciation. Okay, so if you don't know what depreciation is, here's the definition. I'll explain it a little bit further afterwards, but here's the definition. The definition of depreciation is a reduction in the value of an asset with the passage of time, due in particular to wear and tear. So I know what you're thinking, that sounds kind of bad. That sounds like my investment is just losing value over time because it's getting old, right? That's what it sounds like on paper. But this is one of the most powerful tools an investor can use when they are building their empire, okay? So let me explain this here. So my general definition is that on the tax code, is that depreciation of a lot of things. We're going to stick to real estate, but this also applies to a lot of different things. So like it could apply to some cars, some things regarding your business, machinery, some things in your office, computer systems. This could apply to a bunch of different things. What this means is that you can have a tax write-off that is a percentage of the value of your investment. Okay, so let me explain this here. We're going to apply this to real estate. So you get a tax write-off based on the percentage of your investment. And for whatever reason, I follow a lot of real estate channels out there. I haven't really heard too many talk about this, especially a lot of the personal finance people. And so this is largely an accounting thing that you can do to make and save tens of thousands of dollars per year if you're a growing normal investor. We're talking millions of dollars per year once you get up to that higher tier. Okay, so let's move on here. Let's do the example here. So what do I mean here? I'll show you the example. Let's say you are able to buy $1 million property. It's an investment property, okay? So we're going to go to $1 million. $1 million. All right, 2 comma club. You buy a property, $1 million. It is 6 units. 6 units, and let's say they're all like 1-bedroom units. So the rent for these, for each unit, is $975 a month. $975 per month. All right, so this is, I took a very comparable example of what it's like actually here in my area. So this is kind of a sort of typical investment property example. So this is somewhat realistic, actually, pretty realistic. So that occurs over 12 months. So let's say there's 0 vacancies, you collect the rent, and after all of this, you have a gross income of $70,000, okay? $70K a year gross income. So I want you to remember that number. So you have an investment property, you bought it for $1 million or whatever, it's worth $1 million, 6 units, each one sells for $975 a month, rents out for $975 a month, and you get $70K a year in gross rent money. All right, so that looks like a decent investment right now. Doesn't look like the best, but it doesn't look horrible. And so let's move on to the next thing here. We have to do a few calculations here, and depreciation is really going to make sense. So just stick with me here. Depreciation is going to have a massive effect on this rental property. So if you don't know what depreciation is and you're renting out stuff, you better watch this video. Okay, so let's keep going here. So you have operating expenses, right? So when you're calculating your return on investment for a rental property, you have to calculate some of the expenses. So operating expense, OE, operating expense, we'll just put it at 30%, okay? So 30% of your gross income is actually, is roughly the ratio for a good rental property. So this is because you need to take care of things like lawns, property management if you're using a property management company, some insurance, property taxes, maybe the pipes break down or something like that. There's always some expenses you're going to have when you own a property and you're a landlord. So I just put 30%. This can go as high as 50% in some cases. If you're doing like a vacation party place, we're talking 70%. But we're going to stick for 30% because this is a good new property. All right. So after all of this, your net income, NI, equals $49,000. So your net income is $49,000. So after your expenses, which has a cap rate, meaning that your cap rate is 4.9%. Okay, so it's not the best cap rate. It's not the worst cap rate. People like to have 6% cap rates. That's usually the bar for a really good property. But here it's 4.9, pretty much 5%. That's fine. That happens. So Now let's move on to the depreciation aspect, okay? So on this $49,000 right here, you are going to have to pay the government. You have to pay taxes on that. Or do you? This is the magic. This is the power of depreciation that a lot of people do not know. All right, so let's say you don't do depreciation and you have your tax bill. So tax bill, right here. It is, let's say in Canada, it's about a 25% average tax rate. So 25% rate, meaning that on this $49,000, you would have to pay about $12.25K in taxes. So your tax bill on this is about just under $12,500. That's a lot of money for one property. You're paying $12,000 in taxes, all right? So your take home is actually, so take home, TH, is actually $36,000. All right, so this is a normal rental property layout here. All right, so that's what it looks like when you pay taxes, don't do depreciation. Your take home is $36,000. Now let's say you use depreciation. So you have to look this up depending on where you live. All right, so here's the example, is that in Canada, when you own a real estate property, I believe the depreciation called capital cost allowance here is 4%. So what does this mean? It means that 4% of the value of your property, of your asset, your investment, whatever it is, could apply to whatever your machinery, but in this instance, we're going to apply it to real estate. But 4% of your real estate in Canada gets to be depreciated as a tax write-off. Okay, so let's do the math on this. Of this $1 million property, how much of that is the land value worth and how much of that is the property value worth? All right, so this is hard to kind of get to here. This is a whole different video, but we're gonna say that the land value of this $1 million property is worth $150,000. And the property value, so the actual building, is worth $850,000. So depending on where you live, this could be even flip-flopped. The land could be worth way more, the building could be worth nothing. Sometimes it's 50-50. For this example, we're gonna say the property is worth $850,000. Okay, so remember this. Property is worth $850K. Remember that number. The capital cost allowance allowed by the government, so your tax write-off, is 4% of that number. All right? So 4% of this equals, let's see here. So 4%, we get to knock off roughly $34,000. $34,000 in a tax write-off, just because of depreciation for this example here. Okay, so let's keep going down here. We still have to pay taxes now on 49 minus 34, which is $15,000. So now you only have to pay taxes on 15 grand. So what does that come out to? Your tax bill now is $3,750. Taxes. So your tax bill has just gone down from $12,250 to $3,750 for one property. Okay, so this nets you, because you're using the depreciation or capital cost allowance write-off, this is saving you roughly $8,500 to $9,000 in cash for one property. So this is the massive advantage of depreciation that a lot of people do not talk about on here, because maybe some people just don't know about it as much, or for whatever reason, but this is super important. I mean, we're talking when you're building it, by the way, okay, so I should get into the next part here before I move on here, is that you can do this every year you own the property. So for every year you own this property, you're saving $9,000, and then the way it's calculated, it goes down next year, so it depreciates less and less and less every year, for every year that you own it. So Next year, instead of it saving you, $8,500, maybe it saves you $8,400. Then the next year it's maybe $8,200, and it keeps going down every year, but not by that much. So you're actually saving over the lifetime of this entire property. If you own it for 20 years or so, we're talking $100,000, maybe, in tax write-offs plus. And so when you start to do that, and you start to scale that up, all of a sudden, maybe you own $1 million, maybe you own a few of those properties, maybe you scale to $10 million, all of a sudden your depreciation is creating the snowball effect, where every year you're saving money, saving thousands and then 10,000s and hundreds of thousands of dollars, then use that money to pump into more real estate where you get more depreciation. And so by using this example, this loop here, that is one of the key reasons why people get rich, is it creates that compounding snowball effect that I always talk about. You get kind of a compound interest you get a compounding effect from a tax write-off. So this is one of the key principles that I don't hear talked about anywhere near enough, considering that every real estate investor uses this. And it's or should use it at least. Maybe they don't know about it or use some accountant or something so they don't know what's happening. But depreciation is one of the fundamental principles of real estate investing, and building up, like construction businesses use this all the time too, and machinery like factories, they use all of this too. And so it saves giant companies millions of dollars a year, tens of millions of dollars a year. And it's understandably so why it's in the tax code. Because guess what? Buildings do get old. Machinery gets worn out. It's rightfully so. So here's the thing. If you maintain your property well and you get the depreciation, your building might have relatively like the same age, in a sense, the same core age, where it doesn't get a ton of wear and tear on it, but you still get the tax benefits. See how this works? So every year, so you save $8,500 on this property, reinvest, do that for a couple of years, get another property, use all the money you saved up from this property and the next property to get another one, and so on and so forth. This is the snowball effect. All right, read the book, Warren Buffett's book. It doesn't talk about depreciation, but the snowball. It's compound interest, and this is compound interest in a sense, kind of, except you're not getting cash into your account, you're getting a depreciation, tax write-off. It's the same thing. It's just kind of in reverse. Instead of, you're reducing a negative interest rate instead of increasing a positive one. Does that make sense? Okay. Let's just see here. I think that there's one more thing I wanted to add here. Yeah, so here's the crazy example. So the difference here between using depreciation and not, at least from what I calculated here, means that you can probably get about an additional 15 to 20% return on your investment after taxes. All right, over time. That is insane. 15 to 20% additional return. So this is the difference between you making a 4% return and a 5% return, which over time is massive, or 5% and like a 6 point something percent. So this could, if you start doing this while you're young and you buy a property, you buy some sort of investment and you get these write-offs, this alone could be the difference, and I calculated this, between you being a millionaire property owner, so being worth $1, $2, $3 million, and being a $10 million property owner over time, if you do this properly. So, again, there's lots of things that go with depreciation that I won't get into. Maybe that could be a whole separate series, honestly, because depreciation is kind of finicky thing where you have to appraise the land and the property. What's it actually worth? Rates different by country. So in the United States, I think the depreciation rate is 3.6%, and in Canada, it's 4%. So again, rates differ around the world too. So actually, as I'm doing this right now, I'm actually currently redoing my real estate courses here to get my license. And so as I'm going through these books here, I'm hoping to kind of set up I know I see a lot of real estate people out there putting out real estate content, but it's kind of topical, a lot of it's clickbaity. And you guys know me, like I've been putting out real estate and stock market investing principles and things along these lines pretty much since I started. And so I'm going to put out a lot more of these as I go through my real estate license. And I actually have a ton more of these that hopefully you guys will like. So I also click on my playlist for, if you want to see more videos like this, I have a whole real estate and stock market investing playlist. Go click on those videos. They have tons of valuable information like this. And so yeah, go click on those, and I'll see you guys in the next video that you click on, because, well, if you want to learn more, you want to learn more cool things like this, you got to check out some of my other stuff. So I'll see you there.